When you first enter trading, you're instantly confronted with an endless amount of information: indicators, price action, fundamentals, macro data, news, risk, position sizing, and psychology. Trying to absorb and apply everything at once is the quickest way to feel lost, inconsistent, and discouraged. Profitable traders do the opposite. They simplify. They don't trade everything. They don't use everything. They focus on a small number of core concepts and apply them again and again. That's exactly what this video is about. In this video, I'm going to show you 5 trading concepts that, when combined, are more than enough to build a complete trading system: market structure, support and resistance, candlestick confirmation, liquidity sweeps, top-down analysis. You don't need more than that. As Bruce Lee famously said, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." Be that trader. Master a small set of concepts, execute them with discipline, and let repetition do the work. That's how trading becomes clear, repeatable, and profitable over the long run. Now that the importance of simplicity is clear, let's begin with the first and most important concept: market structure. No matter what market you trade, no matter what time frame you use, price can only do 3 things: move up, move down, or move sideways. There are no other conditions. Once you can correctly identify which state the market is in, you immediately eliminate confusion and most bad trades. Let's start with the uptrend, because this is where most traders either make consistent money or lose it by overcomplicating things. An uptrend is defined by a sequence of higher highs and higher lows. A simple way to visualize it is like climbing a staircase. Price moves up, pauses, then continues higher again. Each pause forms a higher low, and each push creates a higher high. What does this tell you? It tells you that buyers are in control. Demand is stronger than supply. Buyers are comfortable paying higher prices, while sellers are unable to push the market lower. Now here's a key point most traders miss. Price does not move up in a straight line. An uptrend unfolds in 2 repeating phases. The impulsive move. This is where buyers step in aggressively and push price higher with momentum. The retracement. This is a temporary pause, where some traders take profits, causing price to pull back before the next push higher. These pullbacks are not weakness. They are a natural part of a healthy trend, and often where the best trading opportunities appear. An impulsive move is the strong and decisive push upward that drives an uptrend. This is the phase where the market moves with speed and conviction, and several forces come together at the same time. Here's what's really happening during an impulsive move. Strong buying pressure. Large players, retail traders, and automated systems step in simultaneously, creating aggressive demand. Breakout participation. As price breaks above previous highs, many traders see confirmation of strength and enter expecting continuation. Stop-loss fuel. Traders who were short against the trend get stopped out. Since closing a short position requires buying, this adds extra upward pressure. FOMO behavior. When price accelerates, emotional traders rush in out of fear of missing the move, amplifying momentum even further. This combination is why impulsive moves often look fast, clean, and powerful. Now, after every strong push, the market needs to breathe. That's where the retracement comes in. A retracement is a temporary pullback within an uptrend, not a trend reversal. It happens for very logical reasons. Profit taking. Traders who bought earlier lock in profits, reducing buying pressure and causing price to dip. Short-term imbalance. When price rises too quickly, fewer traders are willing to buy at premium levels, leading to a pause. Better positioning by smart traders. Experienced traders don't chase impulsive moves. They wait patiently for pullbacks to enter at more favorable prices, in line with the trend. This is critical to understand. Impulses show strength. Retracements create opportunity. If you can read these 2 phases correctly, you stop chasing the market and start trading with it. A downtrend is simply the opposite of an uptrend. Price forms lower highs and lower lows, showing that sellers are in control and supply outweighs demand. Just like an uptrend, a downtrend moves in 2 repeating phases, but in reverse. Impulsive move, a strong sell-off in the direction of the trend. Retracement, a temporary bounce before price continues lower. Now let me ask you something. How do you know when a retracement is ending and an impulsive move is about to start? This is where the second trading concept, support and resistance, becomes essential. Support and resistance are not just lines on a chart. They are areas where traders make decisions. Support is where buying pressure previously stopped price from falling. Resistance is where selling pressure previously stopped price from rising. These levels matter because the market remembers them. In an uptrend, impulsive moves usually start after price pulls back into support. Here's what you look for. Price retraces into a previous support zone. Selling pressure slows down. Buyers step back in and defend that level. When price holds support and starts rejecting lower prices, the retracement is likely ending, and the next impulsive move can begin. In a downtrend, it's the same logic, but reversed. Price retraces into resistance. Buying pressure weakens. Sellers defend the level and push price lower. This is not prediction, it's reaction. You're not guessing where price will go. You're waiting to see who defends the level. Most traders try to enter in the middle of a retracement, or late, after the impulsive move already happened. Professional traders wait for price to prove itself at support or resistance, because when a key level holds, momentum usually follows. A range or sideways market is when price moves between two well-defined levels, support at the bottom, resistance at the top. There is no trend because buyers and sellers are balanced. A range forms because both sides have limits. Buyers are willing to buy, but only at lower prices. Sellers are willing to sell, but only at higher prices. Neither side has enough strength or conviction to break the other. This creates equilibrium. That's why ranges are dangerous. Breakouts often fail. Traders enter too early. The market punishes impatience. So far, we've established two things. A trending market moves in two phases, an impulsive move followed by a retracement. In an uptrend, when price breaks a resistance level, that level often becomes support and helps us identify where the next retracement may end. But this raises a critical question. How do you know exactly when the retracement is over and the next impulsive move is about to begin? Support and resistance give you the area, but they don't give you the timing. That's where the third concept comes in. Candlestick patterns. Candlestick patterns are what allow you to confirm that buyers or sellers are stepping back in. In an uptrend, price pulls back into a support area. You wait for bullish candlestick patterns that show rejection of lower prices. That confirmation tells you the retracement is likely ending. This is the moment when sellers lose control, buyers step back in, and a new impulsive move can begin. In other words, support and resistance show you where. Candlestick patterns show you when. This combination is what keeps you from entering too early and from chasing the move too late. You don't need dozens of candlestick patterns to trade well. You only need to understand a few powerful ones, such as the bullish pin bar. A bullish pin bar has three key characteristics: a long lower wick, a small body near the top. This tells you that sellers pushed price lower, but buyers stepped in and rejected those lower prices before the close. When this pattern forms at a support level, it often signals that buyers are returning. A bearish pin bar has a long upper wick, a small body near the bottom. This shows that buyers tried to push price higher, but sellers rejected higher prices. When it appears at resistance, it often signals renewed selling pressure. A bullish engulfing candle occurs when a bullish candle fully engulfs the previous bearish candle. This tells you that buyers didn't just step in, they overpowered sellers. At support or after a pullback, it often marks the start of a new impulsive move upward. A bearish engulfing candle occurs when a bearish candle fully engulfs the previous bullish candle. This shows a clear shift from buying to selling. At resistance or after a retracement, it often confirms the start of a new impulsive move downward. You don't need to be an expert to trade the market. Every time you open a chart, your first job is only to answer one question. Is the market trending up, trending down, or ranging? Once you know this, everything else becomes logical. If the market is trending up, you already know how it moves. An impulsive move, followed by a retracement. So instead of chasing price, you prepare. Here's the process. Identify the uptrend. Draw your resistance levels. Wait for resistance to break and turn into support. Let price pull back into that support area. Now comes the confirmation. When price reaches support and forms one of the candlestick patterns we covered, in this example a bullish engulfing candle, that's your signal. It tells you the retracement is likely over. Buyers are back in control. A new impulsive move may begin. That's when you enter. In a range, the approach is different. Draw support and resistance. Ignore the middle of the range. Wait for price to reach one of the boundaries. So far, you have market condition, key levels, candlestick confirmation. But there's one final concept that explains why the market often moves this way. That brings us to the fourth concept, liquidity sweeps. A liquidity sweep happens when the market temporarily moves beyond a key level to trigger stop losses and pending orders, and then reverses back in the opposite direction. Now let's put everything together and use the four trading concepts: market phase, support and resistance, candlestick patterns, liquidity sweeps. When you open the chart, the first thing you notice is Price is making higher highs and higher lows. This tells you the market is in an uptrend. That already gives you an important rule. You are only interested in buying, not selling. In this uptrend, price moves in cycles. A strong, impulsive move upward, followed by a retracement. You do not enter during the impulsive move. You wait for the retracement, because that's where low-risk entries are created. During the impulsive move, price breaks above a previous resistance level. Once that resistance is broken, it becomes potential support. This level is now important because it helps you identify where the retracement may end. Price pulls back from the highs and starts moving down toward the broken resistance, now acting as support. At this stage, many traders panic, others enter too early. You do nothing yet, you wait. As price approaches the support level, something important happens. Price pushes slightly below support. Previous buyers get stopped out. Late sellers think the trend is reversing. This is the liquidity sweep. The market briefly moves lower, not to reverse, but to trigger stop losses, collect liquidity, prepare for the next real move. This is where most traders get trapped. After the liquidity sweep, price quickly moves back above support. A bullish pin bar candlestick pattern forms. This candle tells you sellers failed to continue lower. Buyers stepped in aggressively. The retracement is likely over. Now you have confirmation. At this point, all four concepts align. Uptrend, pullback into support. Liquidity sweep, bullish candlestick pattern. This is where professional traders enter, not at the top, not in the middle, but after weak hands are removed. Let's take this trade setup. We place the entry at the close of the pin bar, the stop loss below the wick, and the target at twice the risk. Look at what happens next. Price reaches the target. This is not a holy grail. You will have losing trades, and that's completely fine. Losses are simply part of the game. Now let's look at a range-bound market and apply the same four concepts step by step. When you open the chart, you notice no higher highs, no lower lows, price moving sideways. This tells you the market is ranging. There is no trend. Your goal is not to chase breakouts, but to trade reactions at the boundaries. Next, you mark resistance at the top of the range, support at the bottom of the range. These levels are respected multiple times, which confirms the range. Inside the range, you do nothing. All decisions happen at the extremes. After the liquidity sweep, price fails to hold below support. A bullish pin bar candlestick pattern forms. That candle tells you lower prices were rejected. Sellers are trapped. Buyers are stepping back in. Now you have confirmation. At this point, all four concepts align. Range market, support level, liquidity sweep below support, bullish candlestick pattern. This is where experienced traders enter long, targeting the move back toward range resistance. At this point, you might think you have everything you need, but there is one final concept that ties all the others together and filters bad trades. Top-down analysis. Top-down analysis means you don't trade in isolation. You use one trading time frame where you execute your trades, one higher time frame to define context and direction, nothing more. Your trading time frame is where you identify the market condition, draw support and resistance, spot liquidity sweeps, wait for candlestick confirmation. Your higher time frame answers one question only. Does the bigger picture support my trade idea? You don't need many charts. You only need one level up. If you trade on 5-minute or 15-minute, use the 1 hour as your higher time frame. If you trade on the 1 hour, use the daily chart. If you trade on the 4 hour, use the weekly chart. That's it. No confusion, no clutter. The higher time frame helps you. Avoid trading against major structure. Filter low probability setups. Stay aligned with dominant market pressure. You stop asking, is this a signal? And start asking, does this signal make sense in the bigger picture? Let me show you exactly how this works in real time. This is the New Zealand dollar against the US dollar on the 15-minute chart. As you can see, the market is ranging. Price has been rejected from this resistance level multiple times. So right away, we have two concepts in play. Market phase, we are in a range-bound market, support and resistance. As you can see, this resistance level is a key level to watch. Now look at what happens next. Price reaches the same resistance level again. This time it breaks above it briefly and then closes back below, forming a doji candlestick. At this point, we add two more concepts. Liquidity sweep. Stops above resistance are taken. Candlestick signal, the doji shows indecision and rejection. Now we have 4 concepts aligned: range market, key resistance level, liquidity sweep, doji confirmation. And as we said earlier, in a range-bound market, you trade from the boundaries. So here, all the criteria are met to look for a sell after the doji forms. There's only one last thing to check. Since we are trading on the 15-minute, our higher time frame is the 1 hour. Let's switch to the 1 hour chart. On the 1 hour time frame, you can see that the market is also ranging. Price has hit this resistance level twice, and each time it got rejected. This tells us that the higher time frame does not support a breakout. Instead, it supports a move back down, which aligns perfectly with our 15-minute trade idea. Now we go back to the 15-minute chart to execute. Entry at the close of the doji candle. Stop loss above the high. Target the next support level. Look at what happens next. Price moves down exactly as expected, respecting the range. At this point, you can see that profitable trading is not about complexity. You don't need dozens of indicators, complicated strategies, or constant screen time. What you need is a clear process that you repeat the same way on every chart. If you got value from this lesson, make sure to like the video, subscribe to the channel, and turn on the notification bell so you don't miss the next strategy. Thanks for watching, trade smart, and I'll see you in the next video.